welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for watching or listening to America's Commercial Real Estate Show. Have you checked out ShareFile? It's a program that we use to transfer sensitive documents, right, to folks in our commercial real estate business. And they're a new sponsor. I'll mention them here. It's designed with real estate and other highly regulated industries in mind. ShareFile offers a secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. That was my official radio voice there, if you didn't know. So welcome to the show. Well, we have an interesting one today, and it's something that's on the minds of a lot of people, and that's the amount of distress in commercial real estate. So if you're a lender, a borrower, investor, wherever you are in the commercial real estate world, it's something we're all thinking about. Also, a lot of us have been in the business for a long time and been through a lot of downturns before with a lot of distress, and we've seen how things happen then. And each time, I've been in several of them and done a lot of work in the distressed world, working for banks and borrowers and helping them out with those situations. But what's going on this time? Where are we? What should we expect? What's different? Where's the problems geographically? Where are the problems with sector-wise? Let's find out. Please welcome my guest. It's Jim Costello. Jim is Chief Economist with MSCI Real Assets. Jim, good to see you, sir.
Good to see you. It's MSCI.
MSCI. What did I say?
MSCI.
Oh, I'm sorry.
It's like the CSI TV shows probably on your mind.
There you go. So, but I don't think I can get fired. You can get fired if I say it wrong, so I apologize. Well, let's talk about distress, Jim. I mean, some of the banks we call say everything's great, they don't have any problems, but some of the banks were actually selling foreclosed properties for, especially office buildings. And you guys do a report, right? The MSCI U.S. Distress Tracker. What are you seeing out there right now?
Yeah, we look at this every quarter. How much distress activity out there? Where does the distress line up relative to sales? And it's been increasing, but it's not increasing as fast as what happened during the financial crisis. And that's something that has been puzzling a few folks. But in my mind, it should be kind of expected because every cycle is a little bit different. I have the misfortune or the fortune, I'm not sure which way to put it at this point, of having lived through 4 downturns. Every time we get into a downturn in the market, I see people looking to the playbook of the people who made money in the last downturn, thinking that same playbook is exactly what they need to do to make money in the current downturn. And it never works because there's some high-level figures that always rhyme across downturns, but the fundamental drivers are always different. And you really need to understand the fundamental drivers for property, what's driving the value, what's driving the income, to be able to execute a strategy properly. And the things that drove the financial crisis just aren't around in the same way in our current situation.
Yeah, that's a good point. A lot of investors are out there hoping to find distress, and they're just struggling so far. Is that what you're seeing, and do you expect that to change?
Yeah, it's distress sales as a portion of total sale activity. Over the last 2 quarters, it's averaged around 2.5% of total sales. Let's go back to the financial crisis. That started in December of 2007. And you go 2.5 years after that point, distress sales as a portion of total in around middle of 2010, you're up to almost 20% of the market was distress sales as a portion of total. So, and I mark the 2.5 years in because the way I look at it, the current situation we're in is this great repricing. There's 2 different shocks we're dealing with. We had the first shock starting in 2020 as everyone went home and worked on their couch, and we dealt with a different kind of lifestyle at that point. But then we had a second shock starting in 2022 when interest rates started going up. It's that second shock, that financial shock, that should lead to more financial distress. But, we're only, in that 2.5 years out, only at 2.5% of sales is in that distress world versus the close to 20% in the financial crisis. So there's some differences. System.
Well, no. So if it took 2.5 years to get to the peak last time, so that would put us in 2025 if we were looking for a peak or trough.
If everything plays out exactly the same way, but we're on a different path so far. It's been going up slowly, a little bit at a time. We had two different spikes in foreclosure activity and then some distressed sales. The first was the hotel market. We saw a lot of foreclosures very quickly on hotels in 2021 and late in 2020. And that was a combination of both. There was a hotel-specific financial sector shock starting in the fourth quarter of 2019. There was one big default in the hotel market, and everybody pulled back out of fears that maybe Airbnb would take away the hotel market. But then the COVID crisis hit, and that was a 1-2 punch. And we saw an immediate spike in some hotel foreclosures and distress in the hotel market. But then we have a new round of distress hit in the market, and that's the office sector. It's a financial shock. You had rates going up in 2022, long-term mortgages and long-term leases burning off, and owners and lenders having a sit down and realizing that it just doesn't make sense like before, and so you start to see an uptick. But it's not at the same pace as in the financial crisis, and part of it is that prices are down sharply for the office sector, particularly for CBD office buildings and the expensive coastal markets. But we don't have the same kind of decline in prices that we saw, by and large, that we saw in the financial crisis. So there's just not as much of that kind of price change there.
Yeah, that's a good point. The performance of most every sector is pretty good, right? Except for, like you said, CBD, large office buildings and large suites. And as another thing making it different, Jim, kind of the amount of liquidity and cash in the market. I remember during the recession, going to ICSC Recon, and where people were in their booths hiding, and they'd peer out and say, "Do you have cash?" No, and they jump back in their booth and hide. It seems like there's a lot more money around today.
Yeah, it's the amount of money that's out there can change market behavior. In the early stages of the financial crisis, nobody had money. It was literally a financial crisis. Liquidity was dear. Nobody was lending. But eventually, central bankers worldwide realized that they had an asset price decline underway due to the lack of liquidity. So they started injecting capital into the system. That was the whole quantitative easing process. Prop up the value of assets, put a floor under things so that you don't have this continual downward spiral. And eventually that stabilized. What we're dealing with today, a little bit of the opposite. There is liquidity out there in the sense of there's still a lot of dry powder, investors wanting to put money to work. It's something that's cash yielding. But the central banks aren't cooperating to the same degree. Now they're withdrawing liquidity. They've withdrawn liquidity. They've stopped the QE process. They're cleaning up some of that mess, and they've raised rates. And so that is a bit different. But there's still some money out there looking for a home and looking for some kind of yield. The problem with the distressed asset sales today, a lot of it's not that high leverage deal that just needs to be refinanced at a more appropriate level, but it's still cash flowing otherwise. That's not what's happening. Some of the distress it's hitting, it's fundamental distress. It's highly vacant buildings where the economic justification for the asset has changed since the initial purchase. It's office owners with an 85% empty building and no capital lined up to do the leasing and retrofitting needed to bring the building back to the market. It's the dead mall with the orange tile and brown carpeting this CapEx, but the only CapEx is going to get us from a bulldozer. It's the hotel building that sold in 2021 that it was totally empty because everybody was afraid of COVID and nobody was traveling. So it's a different kind of distress system. It's a fundamental distress as opposed to the distress that we saw after the financial crisis. There were otherwise cash flowing properties that just need to be financed at an appropriate level. And so it creates a different dynamic in terms of who can buy it.
Yeah, and that's a good point. One of the things that we're obviously seeing, though, is that folks with maybe floating debt that's doubled in on the rate, that's causing some distress, or they have a maturity and they're paying 3.5% and now need to pay 6.5%. So you're seeing some of that distress, right?
Listen, I'm not saying that everything is just fundamental distress. There are some folks, particularly folks who got very active in 2021 and 2022 when rates hit record low levels. There are some folks who got ahead of their skis, particularly like apartment syndicators. Apartment syndicators in the Southeast and Southwest were very active. And some of them, if you're buying a Class B apartment building at a 3% cap rate tied to short-term debt, you're going to have a bad day. There's no way out of that easily as rates go up. But that building is going to be a little bit different than an empty office building in one of the expensive coastal markets because there still is some fundamental level of demand in place that's easy to recognize and easy to quantify. Quantifying how much demand there will be for an office tower on Fifth Avenue in Manhattan, that's a harder thing to figure out.
Yeah, good point. I sell foreclosed office buildings, and we're getting much busier than we were a year ago. In fact, I'm going to have one coming out that's beautiful building, 135,000 square feet, and I think somebody will be able to buy it at $80 a foot. It's probably $800 a foot to replace it. It's just amazing. I think the investors out there that are looking for distress opportunities, if they can stomach office, this might be the place to be. Geographically, what are you seeing on your distress tracker?
The markets with the greatest concentration of distressed assets today, it's the large, expensive coastal markets. Manhattan, San Francisco, Los Angeles, the boroughs of New York, Chicago. It's kind of a coastal market.
Yeah.
Those are the top 5 markets for the amount of distress that's out there, because it's an issue of the fundamentals hitting those markets with less office demand, fewer people in the office, more work from home, kind of detracting from that activity. And it's creating a situation of uncertainty. And then you get the current owners and the lenders just pulling back and just not as confident in the future.
Is the percentage of the distress out there in office over 50% of the distress?
Well, it's growing as a share total. What I find interesting, though, is sort of the time lag. Hotel saw a high rate of foreclosure, relatively high for this cycle, in late 2020 and 2021. And now we see the sales out of distressed situations reached up to a little over 7% for the hotel sector in the second quarter. That's the most distressed sales for any sector. The office sector is still not as high in terms of the amount of distressed sales, even though the foreclosures are rising. It's going to take time for all those foreclosures work through the system and get into that point when you have a sale after a distress situation. And it's like less than 4% of the market for the office sector. But it's also a little bit different this time through, in the sense of you don't have the current owners fighting a foreclosure, trying to prevent the property from getting in the hands of the lender, because they look at the situation and they understand that, hey, everything's changed. All our assumptions around demand, all our assumptions around income are different. Let's just have a clean break from this and move forward. And so you see a lot more situations where people just shortcut the foreclosure process They work with the lender and they just engage a broker directly and just figure out some way to get the most for the asset today without having to go through legal processes and deal with loan workout negotiations. It's so that is a little bit different as well. It's cleaning up a little bit faster because of that.
Yeah, and the biggest price correction then obviously is been office, right?
That's right, particularly CBD offices. But even the CBD offices, the price declines seem to be moderating. There was a financial shock starting in 2022 when interest rates rose. And as those rose, so did mortgage rates. And as mortgage rates went up, LTVs went down in terms of what people would originate. And you create that kind of uncertainty in 60% of the capital stack, and you're going to have a bad day. And the CBD office buildings, our RCA CPPI fell at a peak around 33% year over year and at the end of 2023, but it was only down 24.7% in the second quarter. So it's improving in the sense that the declines are moderating. It's still bad. It's still falling at a high pace, but there is some improvement even there. Other sectors are seeing the same thing. The biggest declines in prices were in the past, and some like retail is very close to the growth. Relative to the last quarter, prices were up actually for retail.
Yeah, retail, most places is doing really well, isn't it? Jim, were some of the lenders that maybe extended loans maybe pushing things a little harder now? It seems like some of the banks we've dealt with, their appraisals were kind of high, and I think it didn't kind of force their hand to do anything. And it seems like some of the appraisals are starting to come back down where they really should be. And we're seeing some of the banks that we work with, all right, we've got to short sell this, or we're going to sell this note, or we're going to foreclose and work through this. What do you see on your tracker there?
The type of activity by lender, I think the critical issue that you have to look at, we have some upcoming research on that. I had a meeting with one of my team members this morning on this part, so it's not out yet, but it's the vintage of loan matters an awful lot. If I made a loan in 2022, that's going to be the most problematic one because you were at record highs for prices, money was cheap and easy, and just early 2022, and then it all started to go downhill. As opposed to if I made loans, very long-term loans, starting back in 2014, like a 10-year term, you've got some price growth along the way. Sure, prices are down from the peak, but you had some price growth along the way beforehand, and so the underlying collateral still has some remaining value that could be used to pay off the loan. So those are easier to refinance and have less problems. It's sort of the vintage of the loan that becomes the most problematic element.
Yeah, that's a good point. And are most of the distress, what type of lenders are you seeing the most distress? Is it CMBS? Is it really large banks? What do you sense there?
Points on that. CMBS, there is more activity there in a sense of there's less wiggle room in the negotiation. There's not the ability to call up your local banker and say, hey, listen, Joe, I've got a problem here. Just give me some time to figure it out. But once you get into some trouble, you really kind of have to go into that whole special servicing approach. So it's always going to be a little bit more heavily focused there. But the other thing that starts to happen, those price declines I noted, again, that's more of the office buildings and the expensive coastal markets. If I'm a banker in Tulsa, Oklahoma, I'm not making office loans on Fifth Avenue in Manhattan. That's just not. Bankers stay in their lane. They're active in their local market, and they're supporting the investment and the development of their local markets. And the price declines from the changes in the fundamental use of real estate in a local economy are most intense in these expensive coastal markets because they had the biggest demand shock from COVID and have had the biggest change in how people think about and use real estate. Tulsa, It's just going to have less of that kind of change compared to Manhattan and San Francisco and Chicago.
Yeah, good point. And I'm glad they're staying in their lane. I know during the last recession, some of the banks had done participation loans and kind of gotten out of their lane, and they were surprised. We worked on one that was a $100 million loan that foreclosed on, and there were lots of banks involved in that really had no idea what they were loaning on.
Well, there is some of that still happening. So, those smaller banks, some of them will have exposure to that stuff. And that was a way, and that still happens. Note sales happen. People want to diversify part of their portfolio, get some exposure to other property types, other locations, to help balance some of the risk that they face. So those small banks, some of them probably do have exposure in that way. I don't see that. I only see what's originated. But generally speaking, that's not going to be the biggest portion of a bank's portfolio.
Yeah. Well, that was interesting when there was a lot of banks and we were chosen to sell that property. And that was in Arizona outside of Phoenix. So it was interesting to see all those banks involved and really didn't know what they were loaning on. It says, oh, we'll throw in a couple million here and we'll be okay with it. It seems like the lenders this go around know more about real estate. They know more about how to handle this, I think, than the last go around. Do you see any of that?
Well, the last go around was within the life and work experience of many people active in the market. So there is some institutional memory still out there of what worked and what was successful in the last downturn.
Yeah.
In some sense, that can almost be a problem because of, for the people thinking I'm gonna make hay out of the downturn like people did in the last time. Maybe they pursue the wrong kind of strategy, looking in the wrong place for success. On the other hand, it does create a situation of you have people who remember what it was like trying to figure out what bill to pay and which group to work with and not. And that gives some institutional memory in terms of how to survive everything. Yeah. And that's why I think that some of the borrowers are just working directly with the lenders, remembering what it was like going through a loan workout process and the ugly process of negotiating on that, and how that can potentially ruin relationships. When you need the lenders as partners for other things you're doing in other asset classes and property types that are more successful today. And so people have a little bit more of an attitude of let's just cut through the BS, get right to the heart of the matter, solve problems, and then figure out how we grow moving forward.
Yeah, I think it's a great time for lenders to build great relationships with their current borrowers and new borrowers, and I think it's a great time to do loans. I think for these lenders because when we get to maturity, hopefully we won't have rate shock problems. Hopefully we won't. And then, you have probably a lower loan to value, you probably have a higher debt coverage ratio, you have less competing lenders. So it seems like a great time for lenders to be busy.
Shock in the other direction too, because the shock is just disturbance from where you were. Maybe it goes down more.
Yeah.
I bet a bunch of your listeners will hope for that.
We all hope for that. And while we're on this topic, we do a monthly newsletter for banks and for lenders and groups that buy notes on REO and special assets. And we do a tip each month because we worked, I think in the last recession, I had about 100 banks I was working for at one point. And I did see what they did wrong. I did see what they did right. And I spoke at banking events on it. And so now we're kind of using that experience of what's going on now and what we've seen folks do in the past recessions on the lending side. So if anybody out there wants that newsletter, reach out to me and we'll put you on the list. My email is michael@bullrealty.com. And Jim, your report on the U.S. distress tracker, some of that's available right on your guys' website.
Yeah, most of it is for current clients. It's kind of behind a paywall, but there is some information that's available from our group, and I can provide people with some examples of that if they want to reach out.
Yeah. Yeah. So their website, if you'd like to get more information, is MSCI.com. We'll get it right. Jim, what would you leave our audience with to think about distress right now?
The way I think about distress is that, there's a repricing event underway. It's not as extreme for most cases as in the financial crisis. So you don't have some of the same momentum around the downside to play with. And more of the distress is a fundamental change. So I think this downturn and the people who reposition distress, it's not going to be the suits in New York flying into a city, putting an appropriate debt structure on a building and leaving. It's going to be the people in a local market who understand the local zoning agency, understanding what it takes to kind of get a permit pulled. Someone who can swing a hammer and reposition a property. There'll be a lot more local, private kind of investors repositioning the distress today.
Yeah, good point. And Jim, if you don't mind, for our viewers who watch this show, can you put on the cool glasses there? Let's see how those look. And if you're listening, we apologize. Yeah. Oh, they're.
These are from the Mortgage Bankers Association.
Oh, nice.
They are bamboo. They're free. If you go to the mortgage bankers events, they pass them out. But the funny thing about them, I live in Brooklyn, in New York. I'm walking along one day, and some young African-American men see them on me, and they say, "Wow, those are cool glasses." And I'm like, "Really? You just making fun of the old white guy?" The guy was like, "No," and I told him, that African-American men are always like the arbiters of style. They started laughing, and the guy was like, "No, they're cool." So I gave them to him. It's like, no, seriously, they're free. They're from a mortgage event. Mortgages.
Yeah.
Yeah, maybe you could be a lender too.
Yeah.
That really shocked him. Like, what do you mean? Well, wouldn't you like to earn a commission for originating a loan on an office tower?
Yeah.
And he got quiet and he said, well, I can't do that. Why can't you?
Mm-hmm.
And just had a nice conversation with the guys. And, one of them was going to Fordham here in New York. And I said, take some real estate classes. That could be you.
Yeah.
And it led to a fun conversation.
Yeah. Well, that's great. I mean, what a wonderful business that we're in. And I feel really lucky to be in commercial real estate all my life. And I get to meet people like you. Jim, thanks for being on the show.
Hey, thanks for having me.
All right. And thanks for joining us around the country. Please let us know what you think. I'll ask you a favor. If you will share the show, pay it forward. It's great information. I think you probably appreciate it. If you do, please forward it. And connect with us, if you will, on your favorite social media. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by CCIM C5 Summit. Will be at the Hard Rock Hotel in Hollywood, Florida, September 17th to 19th. Visit c5summit.realestate. By ShareFile. Designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By CREI Summit. This will be in Atlanta, Georgia, September 11th to the 13th, right here in Atlanta, Georgia, where we're headquartered. Visit cresummit.com. By Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guest at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.